Every time you place a trade, your order goes into a queue most traders never actually look at. That queue is called the order book, and understanding it changes how you see price movement entirely. An order book is a real-time list of every buy and sell order waiting to be filled for a given asset, organized by price level. It has two sides: bids, which are buy orders, and asks, which are sell orders. Bids are sorted from highest price down, asks are sorted from lowest price up. The highest bid and the lowest ask are called the top of book, and the gap between them is the bid-ask spread. The tighter that spread, the more liquid and efficient the market is considered to be at that moment. When you place a market order, you're not trading against the market in some abstract sense. You're matching directly against these waiting limit orders. A market buy order fills against the lowest available ask. A market sell fills against the highest available bid. This is the actual mechanism behind execution, and it's why large orders can move price even without any change in sentiment. Order books also reveal depth, how much volume sits at each price level. Thin depth means large orders can move price significantly because there isn't enough resting volume to absorb them. Thick depth means price is more stable because large orders get absorbed without much movement. Depth is why the same size order can have completely different effects depending on which asset, which exchange, or which time of day it's placed. This is where the concept of order book imbalance comes in. If there's significantly more resting volume on the bid side than the ask side, it can signal short-term buying pressure. The reverse, heavier ask side volume, can signal selling pressure. This is not a guaranteed predictor, since large orders can be pulled from the book before execution, a practice sometimes called spoofing when done to manipulate perception rather than genuinely transact. Another important concept is order book resilience. How quickly the book refills after a large order consumes several price levels. In highly liquid markets, other participants quickly place new orders to refill the depth that was consumed. In illiquid markets, that refill can take much longer, leaving price temporarily displaced. It's also worth understanding the difference between the order book and the trade tape. The order book shows what's waiting to happen. The trade tape shows what has already happened, completed matches between buyers and sellers. Traders who only watch price charts are only seeing the tape. The order book gives visibility into what's queued up to happen next, which is why it's a core tool in short-term execution analysis. Say Bitcoin is trading at $60,000. The order book might show bids stacking from 59,990 down to 59,900, and asks stacking from 60,010 up to 60,100. If a large market buy order comes in, say an order sized larger than what's resting at 60,010, it will consume that level entirely, then move to 60,020 and continue climbing through the book until the full order is filled. Price moves up as a direct mechanical result of consuming that resting liquidity, not because of any external news or sentiment shift. If that same order had come in during a period of thin depth, for example during low liquidity overnight hours, the same order size could have pushed price substantially higher, because there would have been less resting volume to absorb it at each level. The order book is the actual mechanism behind price movement. Not sentiment, not the market deciding, but real orders being matched at real price levels. Understanding depth, spread, and imbalance is the foundation for reading how liquidity affects price, and it separates traders who understand execution from traders who only watch a chart. If this helped clarify market mechanics, subscribe. A new breakdown posts every Monday.